Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. And the Trump tariff tantrum is hurting global markets. Indian markets are in the red, but not deeply in the red. Nifty Sensex down close to about 1/3 of a percentage point. The Nifty is at 23,280. A minor cut of close to about 50 points. We opened much lower. And from there, we've managed to recover. Banks are helping. The Nifty banking index is up in the green. Pharma is higher. And barring IT, where you're seeing a big fall, the Nifty IT index has collapsed nearly 3.5%. The other sectoral indices are getting away with minor cuts. The auto metal index down about 0.5 to 0.7%. But let me straight away invite Rohit Srivastava, who has been waiting by very patiently from IndiaCharts.com to join us on the show. Rohit, thank you for joining in. Are you surprised by the market reaction? Were you anticipating a deeper cut?
Well, I was not really hoping for a deeper cut because I have been waiting for this market dip to end and for the uptrend to really resume. So I can say that I'm happy that it's not been as bad as it could have been. So it looks like a normal reaction as part of a correction to an ongoing uptrend. We saw a pretty sharp rally of 1,000 points, and we've given back quite a bit of that. Probably around 50% of that we've given back. But that puts us in a place where we can actually make one more higher low. So if you take it from the bottom of March, we first made a higher low, somewhere around mid-13th, 11th to 13th of March. And now we are probably ready to make a second higher low. And that's a sign of an ongoing uptrend. And we are probably going to be absorbing all the negative news flow that is, coming our way.
And that higher low would be at what level?
Well, so we are here right now. So the support is around 23,090. That's the 40, day exponential average. Worst case, if we do dip below that, I'll say 22,930 as our worst case support. But as of today, 23,090 seems to be holding. So keeping that in mind, we should be looking for the uptrend to resume. And probably we should head towards what I'll call the 61% retracement mark of the entire fall that we've seen from late September into early March, and that number comes to around 24,630. So we should be looking for that 61% retracement as the next level to go to once we find support here.
Right, Rohit. Good morning, Rohit. Two sectors clearly impacted. One on the positive side is pharma, and the other on the negative side actually is the auto. Which are direct impacts. Now, autos. How do you see that particular trend playing out? And as far as pharma is concerned, quite a few of the stocks have actually cooled off from the day's high. Do you feel this is the start of a new uptrend there?
So first on autos, I think it's a very much domestic sector, except for Tata Motors owning some of the foreign brands. So in that sense, why should we be impacted so much? The fear of foreign competition, I don't think is maybe also significantly discounted.
Autos as well as quite a few auto ancillaries as well. Names like Bharat Forge, Motherson, Sona.
I get that, but we still produce much cheaper, I guess. And in that sense, it doesn't. It's really a question about demand for the end product rather than about the price. So I don't think price will become a reason for the profits to go away. Having said that, a lot of them have seen a steep correction. So if you actually take the last 4 to 5 months, we may have discounted a lot of that already because auto sector was one of the weakest performers of the last 6-month correction. So how much more downside are we going to price into it? The next thing I'll think of from a domestic perspective, if the interest rate cycle is turning down, then these are the areas where you expect demand to come back, right? So domestic auto would be where you would expect demand to come back. But yeah, ancillaries, I get your point. But they've also seen a correction. So in that sense, is it really discounted is what you have to think about. Now, on the pharma side, while the pharma stocks do have a short-term fillip on not getting taxed, when we look at the structure, long-term we are good. But medium-term, I think, it may not be quick and easy to the new highs because, the monthly momentum is still showing weakness, whereas the weekly momentum shows us some positivity. What that really means is that you can retest the highs, but you might still be in a consolidation mode for the pharma sector from a 6-month perspective. But a 2-3 year perspective might still be good. So I think in the short term, it may do well. But 6 to 8 months, you may see it, again weaken somewhere and pick up much more only later because it's actually done pretty well last year.
What are the global macro indicators telling you? The US dollar, the bond yields, the US futures right now are pointing to a very weak start when US markets open tonight. What's the global picture telling you?
So on the global front, the US market, if we look at sentiment indicators, was already bleak ahead of this event. What happens with events like this is that all the news flow tends to end up coming beforehand, which means, number one, you already knew there were going to be tariffs. Number two, you already knew that they were going to be less than what we are putting on the US, because he said that he's going to keep it lower. So that was also anticipated. So sort of the market ends up discounting it in advance. And when the news actually comes in, it ends up being a 1 or 2 day knee-jerk reaction. This is how we've historically seen these things play out. Now, more important than the 1 or 2 day knee-jerk reaction to US equities is going to be, like you said, what happens to the dollar and what happens to bond yields. And apparently, both of them are down, even though you'd think that, higher tariffs mean more inflation. Bond yields are actually off. And better still is Indian bond yields have been falling for quite some time. And if US bond yields remain suppressed, that actually helps the emerging market yields, because they're sort of correlated. And when yields are going up, then we were pressured on the upside. Now that yields are going down, it makes it easier for us to actually go into our interest rate cutting cycle, which we've already stepped into from the month of February. So that's actually a good thing for India, that interest rates or bond yields are actually heading lower. And the second one is, of course, the dollar. So if the dollar index is also entering a bear market, because it's closing now below the 20-month average, and the USD INR also has started to weaken on the daily, weekly, monthly indicators. In fact, even the quarterly indicator is in sell for the USD INR. That sort of sets a stage for a strong rupee, lower interest rates, which is very, very conducive to both foreign flows and a better, market for, in terms of demand from lower rates. So overall, I think the setup for India still remains very, very good. The macro factors are pointing positively, and that's what will end up, helping us recover in the end.
Rohit, I think we missed your view as far as crude is concerned, in case you do have a view over there. And secondly, IT stocks today have seen quite a bit of a beating. Do you feel start of a new downtrend, or it's more of a knee-jerk one-day reaction?
I think it will end up being a knee-jerk reaction, because they've already fallen with the US. And as the US goes through its knee-jerk reaction over this event, the IT sector also goes through that and then recovers with the US market. I think that is how I look at IT short term. But, medium to longer term, we can still have growth concerns, because IT sector is a defensive sector. When nothing else grows, it continues to grow at 5-6%. But when you get growth back and you have higher growth rates in other sectors, you will tend to not want to own too much IT. So in that sense, it's not the most favored sector, but surely short term, if you're still looking at it as a buyer, then we should be getting, this knee-jerk reaction should end up giving you that short-term bottom in the IT sector itself. On oil, what I would say is that it's been much more suppressed than other commodities, because, weak dollar typically means that the commodity cycle should pick up. We can see that in gold, silver, copper. Aluminium sold off, I think, on this news in the short term, but it's still higher than where it was last year. But oil prices have been suppressed, and I'm not sure we are out of the woods on oil prices yet, because the US has continued to promise, higher production. We need to certainly break past. We've gone past 70, I think around $78, $79. If we don't get past, then there could be another leg down, especially when, if at all you get the, peace in Ukraine, that could mean further supply of oil. So oil is the odd guy within commodities, which is not picking up, and you need to be open to that, potential event. For one last downside, somewhere below $70, maybe closer to 60, 55, somewhere there is where I think oil eventually bottoms. And it could, in that sense, it's also a good thing, because it keeps the pressure off, at least from the oil side, on inflation.
Thank you so much, Rohit, for joining us, giving us your view on macro, micro, as well as individual sectors as well, on a very important and a very volatile trading session like today. Well, let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.